Today, Warner Music Group filed with the SEC to launch an IPO of 70 million shares in the range of $23 to $26, which could potentially raise up to $1.8 billion. Len Blavatnik's Access Industries and others are selling these as secondary shares, meaning proceeds won't go directly to the company. It will be a controlled company, meaning Blavatnik will retain control of the company and Access will receive whatever proceeds the IPO brings in. First, a little background. Blavatnik bought Warner Music in 2011 for $1.3 billion. Before that, it was a publicly listed company from 2005. Time Warner sold Warner Music in 2003 for about $2.5 billion to an investor group led by the Seagram heir Edgar Bronfman Jr. and private equity firm Thomas H. Lee, which turned out to be a convoluted mess that many blame Bronfman for. Right now, depending on how you look at valuation, it could bring Warner a valuation between 12.5 and 19 billion. So you have a wide range there. Do people really want to invest in the music business right now? With Blavatnik controlling the funds, does this look like a setup for an acquisition run? With his take on this, let's turn to Sam Tall and discuss this a little deeper. Sam, how are you?
I'm well, Peter. How are you?
Good, good. How's everything out in LA?
It's, you know,
Week, whatever.
prototypically great. It's brilliant. It's sunny. It's people are naturally distanced by virtue of being in cars. So no worries over here.
Fantastic. Less traffic.
Yeah, it's certainly less traffic. That's definitely the upshot of it.
So Sam, I know you saw the news.
Yep.
What's your thoughts on this?
What a way to wake up this morning.
Yes.
Being in Los Angeles, we're 3 hours behind the curve a little bit. So the 9 a.m. news is 6 a.m. and I don't see it for a little bit. But I think it's this is one of those news stories, one of those days in the music business that every platform is going to cover. Every, Music Business Worldwide, Music Week, Billboard, Music Ally, like they're all going to have their teardown of the filing and watching the stock price closely, similar to Spotify's IPO a couple of years ago, and all the sort of talk about a potential UMG pseudo or partial acquisition, for example. But I think what you mentioned about this kind of setting up a run of acquisitions and kind of raising capital for that purpose, I'll be really interested to see what that actually looks like. We know that BMG beat that drum for a while. Downtown grew very quickly as a result of focusing on catalog and company acquisition versus direct signings. Reservoir, Concord, similar story. So the sort of like independent pack, those leaders of the independent publisher space are really aggressive about it. And, it stands to reason that now that that's a tried and true sort of strategy at that level, that it's time for the majors to do the same thing, which I feel like they might have been a little bit more, quiet and hush about in recent years.
And the interesting thing, to go back, if you look at this and going with some of the valuation, and they were looking at the Universal situation years ago, and and how that was unfolding with Tencent owning a 10% stake in the company, so it was a little more challenging. And so some of the valuation is based on that, and that's where they were coming in at the high end of the 19 and a quarter billion.
Uh-huh.
But the thing here that also that I look at is in the past when Warner was public and then they had that spree, then it unfolded and then the industry changed. So in 2005, at that time, we were bottoming out. It was the race to the bottom. Mm-hmm. And that's when investors were really shying away. So is this that moment where we see all this catalog acquisition going on? Is this a prime time for people to be investing?
Well, regardless of the industry, right? Recessions breed consolidation. We've seen that in past decades, past eras. And I think this is potentially another scenario where that can occur. And, with the sort of the unbundling of EMI, for example, and, all this stuff around Citigroup, and then the the way that assets changed hands, the way that Warner picked up pieces and parts and then had to, shed some bits. I think it's certainly it'll be fun to watch. It'll be interesting. I think the difference now is that rather than being in the middle of a downturn in terms of the recording business, putting aside the macro economy for a second, rather than the industry bottoming out, we're on a serious hike. Every year we're posting bigger and bigger numbers than the year before, and we're on a really, really positive trajectory, which makes this like very compelling territory, which is, of course, evidenced by Mercury Curiatis and Hypnosis Songs and the fundraising that he's done. So I think that might be, hopefully this presents an opportunity for the industry to stabilize in a way that kind of insures itself and buffers against other sort of platform and format changes that could disrupt the revenue pipeline. But if anything, for the immediate, it certainly seems like a good cash run for access.
Right. And, looking at, looking here, Warner Music earned 258 million in fiscal year 2019 on a revenue of 4.48 billion, and stating that recorded music generated 3.84 billion, or 86% of total revenues.
I mean, publishing, here's the thing, publishing is limited by statute, right? There's the consent decrees on the performance side. There's the mechanical royalty statutes that kind of cap what can be earned realistically. But there's no floor to that. So there's always negotiations away. Publishing is so fraught with legal language, whereas the recording business is so market-based that of course it's going to be distributed like that. And it's similar to how the platforms are paying out their royalties, is how the companies that the labels make their money. And then they obviously have certain cost structures in place. And if you look at Spotify's cost structure, this is what makes it so different between a company like Spotify, which itself is maybe in the original content game now with podcasts, but hasn't quite been there with music. Their cost structures are like 85%. So their margins like 10 or 15 at best on a good day. Right. And they're still running a loss. And that's largely because a lot of their money has to go out for royalties. Whereas for Warner and for other major labels, and less the case with independents, a lot of their money doesn't have to go out for royalties. It has to go out for salaries, for infrastructure, for debt, payments, servicing all of that, lines of credit and things like that. But if I remember correctly, reading the reports this morning, only something to the extent of like 40% of their cost basis, or 40% of their revenue is allocated towards like artist and repertoire and other sort of catalog expenses. Is that right?
Mm-hmm. Yes. Yeah. The operating,
which seemed low to me, to be honest,
exactly,
but
yeah.
That's the business.
Yeah, they were saying that, but that was, that's how they were doing that valuation, is also, stating that, using the multiples of the operating expenses and everything, that's how they're getting this different valuation. So again, it's that numbers game, the fluctuation between, is it going to be 12 or 19 billion? So it's going to be interesting.
Part of a whole stack.
Yeah.
With Warner and Deezer and a little bit of Songkick in there, and there's just like, I think what this potentially sets up, if a majority of the proceeds of the equity sale attributes directly to Access Industries, is a pretty interesting clash of titans between Access and Liberty Media, who's been talked about as a potential suitor for UMG shares. They obviously have their stake in Live Nation and iHeart and Sirius, and so it's kind of a very consolidated sort of industry, getting to be like a PepsiCo or a Kraft Foods kind of like super consolidated multi-brand scenario. Who knows? But I think this is going to play out a lot longer than the rest of this year.
Yeah, and this was something that was they were talking about floating in February before everything happened. And that would have been a terrible time. But now they opened up, the stock exchange floor, and all of a sudden we're back on a rise. So I think it was a big day on the floor today. So one of the things you also mentioned in there was like royalties. And last week we discussed Spotify's countersuit to the indie label Sosa Entertainment. Covered quite the backstory on it, but just refresher is that Spotify claims Jake Knox's label, Sosa, designed a scheme to artificially generate hundreds of millions of fraudulent streams. This was in response to a suit filed by Jake to Spotify for over $1 billion for failure to pay royalties on the 550 million streams, and that company's Pro Music Rights. So we talked in depth about there, and there's still a lot of speculation going on. You've spoke to Jake about this, and what was his initial reaction?
Uh, Obviously, he's not able to say everything he wants to, I'm sure, by virtue of this being an active legal matter. But he is, I will say, very confident, and he's very self-assured about the way that this is going to go, as if there's some sort of exposing of the men behind the curtain, if you will. That's bound to happen, probably in his mind in the nearer term. But I'm sure, as with all true legal battles, this could run on longer if it actually doesn't get dismissed outright, or if it's not just summary judgment kind of situation. I think there's a couple of things here, right? There's a conflict of interest between the fact that he owns a label that's running these streams, as well as owns the alleged PRO collecting the performance royalties. There's nothing wrong with having a label and a publisher. I think there's just a different sort of conflict involved when you have a suit going out for one party, a suit coming in for another party, and a whole lot to juggle around all of that. So hopefully, he's buttoned up, but frankly, I don't know. Spotify is no stranger to the legal system when it comes to royalties. They've been sued, they have sued, and they're very strong on that front. And this isn't also not the first time that Jake and Pro Music Rights and Sosa Entertainment have been in the news about something like this. And so that he's sort of he's got a reputation. He's a little infamous for this.
So far, yeah.
Hopefully,
and we don't know if that's the best way to come out of the gate, swinging as hard as going straight for the jugular. So, Sam, why don't we see if we can get Jake on the show and hear his side of the story.
I'll talk to him. I think when you type over the internet, whether it's in comments or in a Facebook DM, you have an opportunity to check yourself before you hit that send button. I think it'd be a fun to get into a little repartee in real time about it.
Yeah, let's find out. Let's make that happen.